You've probably heard of Michael. He shares on his channel some interesting ideas which have become known as ICT methods or smart money concepts. The idea is to trade with the big money, the sharks, the institutional investors. He has a full year's worth of mentorship content on his channel, and I decided to go through it as I put it into code. A few minutes into the first month's content, he mentions 2 prerequisites, which leads me to the market primer course. The first video starts off with him explaining the concepts he covers in the module. It then goes on to introduce the institutional perspective. The main idea is that as a retail trader, these levels look like support levels where price is supposed to go in this direction, but what is really happening behind the scenes is the big money guys are stop hunting. So let me explain with an example. If you look at this chart, you probably put your stop loss at this level since this is a key area of support. You're not the only one seeing the chart. Most people looking at the chart are also thinking the same thing. At this point, the price went up for a bit, and that would cause you to think price will keep going up. However, the institutional traders are gunning for the sell stops below this level. The price goes lower, collects their stop losses, and then goes up. This means if you had a trade here that you anticipated would go up, your sell stop would have already been hit and you'd be out. Michael also shows how to get into the trade. He mentions the classic OTE but doesn't go into detail in this video. Hopefully I can eventually get to it. He does, however, show how to identify a trade setup without needing to know his classic OTE method. This is where he introduces the concept of order blocks. Unfortunately, he doesn't explain how to identify an order block, but I found another video on his channel that does. Had to go over the first couple of minutes of that video to understand order blocks. And here was the takeaway. So order blocks can be bullish or bearish. The steps he explains for a bullish order block in that video are as follows. You first need to identify an area of support. So from this video, he draws the levels by looking at the chart and drawing a trend line in an area where you have double tops and double bottoms. These are examples of double tops and double bottoms. Once you have a support level, you wait for a red candle to form near the support level. At first I was confused by how we worded this definition, but you can reframe it like this. When a red candle with a sizable body forms near a support level, that's the second condition. The third step needs to validate the red candle in order to qualify it as an order block. Just having the red candle near support level is not enough. So here we have the red candle. This is the high, the low, the open, and the close. When the next candle's price goes above the high of the red candle, we now consider that a bullish order block. If the next candle after the red doesn't go above the red high, this is not a valid order block. He didn't cover the bearish case, he just said it's the opposite. So going back to the market maker video, I was a bit disoriented because he was showing an example using a bearish order block and I didn't have a good framework of what he meant specifically. I made the mistake of watching other videos on order blocks and they introduced even more concepts than what ICT had. So I decided to just stick to the bullish order block knowledge I'd gained from him, and then from the example he was showing, which was a bearish order block, I'll just flip it. So I followed his example and decided I would first of all write down everything he says and then flip that into the bullish order block scenario. So here's what he did in his example. He identified the support levels, identify a green candle that forms near the support level. Once price gets to the low of the green candle, it gets into a sell trade. He then put the stop loss at the high of the green candle, but due to the broker account he has to put 10 more pips away for the SL from the high. And then the take profit, he says, was 20 pips below the support level. So the opposite of this is we still identify the support levels. We identify a red candle forming near the support level. Once the next candle's price gets to the high of the red candle, we get into a buy trade. We then put the stop loss at the low of the red candle and then put the take profit 20 pips above the support level. The coding plan would follow the steps we identified. So first things first, we need to identify the double tops and the double bottoms. Here you can see he has a couple of levels. To make things easier, I went with 2 levels. We have an inner range and an outer range. I know the chart looks messy, but let me turn off the outer range first. The pink lines show the range we are considering, which is the inner range for this case. The vertical lines show how many bars are being considered. The values are adjustable. The candle that is currently forming is considered the 0th candle, and we count from right to left. So if we wanted this range to go back 30 candles, we can change that here. If we now turn on the outer range, you can change the start point to a different start value. Here I have used 10, then we go back 80 bars from the start, which gives us this orange range. To identify the red candle forming near the support level was actually the easy part. However, we have to define what near means. So I went back to his video and his range was 7 pips. I decided to use that as a starting point, and that is what this last setting means on the trading board. So that we can get in action as it's happening, the candle that is currently forming, on every tick that we get, we will be checking the high of the candle currently forming and checking if it goes above the high of the red candle. Once that happens, the bot should place a limit order. We cannot place a buy order because the price might have moved up by the time the order is placed. That's why I went with a limit order. The issue with the limit orders is some brokers have a minimum stop distance that is needed. Luckily for us, there is a function in MT5 that does this automatically. This means if the actual stop loss price is this, we also factor in the broker's minimum slippage to avoid any errors. Also, something else that has been confusing on this video is he mentions that we should not consider wicks and only use the body, but on the demo he shows on this other video he does use the wick. We're going to test both scenarios though, either way, just to be sure. The stop loss goes where the low of the red candle is, and we add the minimum stop distance if needed. And lastly, we add 20 pips to the support level, and the reason why it's 20, it's because he explicitly says that
20 pips below that low at 118.84, it's 118.64. Okay, really simple. Specific price levels, not zones, not ambiguous areas to try to figure out what's going on. It's exact. It's a science. We know exactly what we're looking for.
I have 6 backtesting scenarios. The first I'll just be using the inner range only. We'll also use the outer range only and then use both. We'll then switch up some things and try and do a reward risk ratio of 1:1. That means if the TP is 20 pips away, we also, instead of considering the low, we just do 20 pips as well for the stop loss. You can also try 1:2 reward risk ratio. And then lastly, I'm gonna use just no wicks, just using the bodies. These 6 conditions ended up creating 18 different combinations. Let's start with the wicks variation. Here we have the entry price at the high, the take profit 20 pips from the support level, and the stop loss at the low. The results for the inner, outer, and both were as follows. When I say inner, I mean the inner range. Whenever I say outer, I mean the outer range, and both is when the bot is taking trades from all the levels. And by all levels, I mean the support levels only. We are not dealing with the resistance level. Next, we have the entry price at the high, the take profit 20 pips from the support level, and the stop loss is also 20 pips from the support level. This makes the risk reward ratio 1:1. And here were the results for the inner, outer, and both. We have the entry price at the high, the take profit 20 pips from the support level, and the stop loss is 10 pips from the support level. This makes the risk reward ratio of 1:2, and here are the results for the inner, outer, and both. Now moving to the body variation, we have the entry price at the open, the take profit 20 pips from the support level, and the stop loss at the close. And here are the results for the inner, outer, and both. Next, we have the entry price at the open, take profit 20 pips, stop loss 20 pips from the support level, making a risk reward ratio of 1:1. And here are the results for the inner, outer, and both. Lastly, we have the entry price at the open, the take profit 20 pips from the support level, the stop loss 10 pips from the support, giving us a risk to reward ratio of 1:1. And here are the results for the inner, the outer, and both. Have four main problems with this approach. The main issue is identifying the optimal values to use for the range. There was no scientific or logical steps I took for this range. I would love to hear your suggestions on how we can improve selecting the different range. We also had an issue on risk management based on the lot size. As a default, I just used one lot size. In his video, he does use a bigger lot size, and one can be considered a huge lot size depending on the account size. So we need a better form of risk management. However, it seems the next video will sort that out. The other problem we have is figuring out how often to refresh the levels. That is what this setting here means. In short, we are saying plot the lines, then wait for 20 minutes to recalculate them. I think the 20 minutes, but this should also be a point of consideration to optimize for in future. And lastly, in this video, he mentions the support level can be from a higher time frame. So in this example, I have drawn the levels on the same chart I'm trading on, which is also what he has done in the example in the market makers video. So maybe a good question to ask is, since we have done a backtest using the 1 minute chart, which higher chart can we use to get better range? I don't call this a success or a failure. There is still so much more to learn. I'll keep adding to this project and see how it goes. Let me know any suggestions you have on improving this project. And as always, you can download the bot with the first link in the description.